Welcome to the Deep Dive, where we sift through the biggest earnings calls to give you the context you need.
And today, we are really tearing into Chevron.
That's right, the Q3 2025 earnings call. It took place intraday on October 31st.
And there is a lot to get through.
A whole lot. We're talking record production, a massive integration, and a pretty surprising strategic pivot.
And if you were tracking this, the high-level takeaway is, I think, pretty clear. This was a strong quarter.
Very strong.
It really delivered on volume and, maybe more importantly, on cash generation. The market reaction was positive, but measured.
So investors were happy, but maybe waiting to see what happens next.
Exactly. Happy with the execution, but now they want to see where all that cash gets deployed.
Okay, so let's unpack this, starting with the headline financials. Because these results were a solid beat.
They really were. And it sets a strong baseline for this new combined company. Adjusted earnings came in at, $1.85 per share?
Which cleared the street consensus by a pretty healthy margin. Analysts were looking for something between 171 and 175.
Right. And revenue also beat, clocking in at $49.73 billion.
But the real story here, I think, is the volume.
Oh, absolutely.
Chevron hit a record worldwide production of 4.09 million barrels of oil equivalent per day.
Which is a huge jump, a 21% jump year over year.
And the domestic surge is what really stands out to me. U.S. production alone was up a massive 27%.
That production surge is definitely the headline. But the internal financial mix that's driving that earnings beat, that's where you see the strategy really working.
The integrated model in action.
Precisely. We saw incredibly robust cash generation. Cash flow from operations, if you exclude working capital, hit $9.9 billion.
And that translated into what for free cash flow?
Adjusted free cash flow was $7 billion, just a huge number.
But the segment results were starkly different, weren't they?
A tale of two businesses, really. Upstream earnings were actually down 28% year over year to $3.3 billion.
Down 28%. Why the drop with all that volume?
Lower liquids realizations. It's that simple. Crude oil spent a lot of the quarter hovering near that $61 a barrel mark.
Right, which puts pressure on the E&P margins.
But that decline was heavily cushioned by the downstream segment.
Which just soared.
It soared. Earnings were up 91% year over year to $1.1 billion.
So when the price of your input crude falls, your processing margins just expand. That's the hedge working perfectly.
It's the integrated model in a nutshell. Chevron's refining network completely capitalized on it.
Okay, that perfect contrast proves the value of integration, which brings us to the elephant in the room.
The Hess acquisition.
The $55 billion Hess deal. It closed back in July, so this was the first full quarter we're seeing. How quickly did those assets hit the ground running?
I mean, extremely quickly. Management confirmed the integration is progressing well, which might be an understatement.
How so?
The legacy Hess assets immediately contributed $150 million in earnings right away. And they were the main driver behind that sequential production increase of 690,000 barrels per day.
That's a rapid, tangible impact right out of the gate.
It really is.
And what about the synergy targets? Because hitting those cost savings goals, that was a huge part of selling this deal. Are they on track?
They are more than on track. They're actually ahead of pace.
Really?
Yeah, management seems very confident they'll deliver the $1 billion target they set for this year. But impressively, they've already captured $1.5 billion in annualized run rate savings.
Whoa, $1.5 billion already. So that's a significant acceleration. What are the key drivers there? I saw things like NOL utilization mentioned.
Yes.
For our listeners, what does NOL utilization actually mean for Chevron's balance sheet in plain terms?
It's critical. NOL stands for net operating loss. Hess had a substantial amount of these losses on its books.
Right.
So when Chevron acquired Hess, they also acquired the right to use those losses to offset their own taxable income.
Basically a giant tax shield.
Exactly. It instantly boosts cash flow efficiency. So it's not just about cutting jobs or operational fat. It's a structural financial benefit that really validated their due diligence.
And beyond the numbers, I remember the CEO praising the people, especially that Guyana team. You hear that after every merger, but he seemed to really focus on it.
He was very specific about it. He talked about the quality and talent of the Hess employees they inherited.
What capability do they bring that maybe Chevron was lacking?
He pointed to their ability to drive these complex deep water projects in Guyana. The idea is that integrating people with different experiences helps Chevron innovate across the whole portfolio. He called it a huge source of value that, doesn't show up in a synergy model.
Okay, so that massive cash flow is feeding back home. How is the operational core, the Permian, doing while they're managing this colossal integration?
The Permian just keeps executing. Production is now over 1 million barrels per day.
Over 1 million.
Specifically, about 60,000 barrels a day over the plateau target they had set for themselves.
Wow.
But the strategy is shifting a little. The focus is moving away from just aggressive growth, toward prioritizing cash generation and capital efficiency.
So if they're hitting those targets using fewer rigs, are they sacrificing marginal barrels for an efficiency metric? Is this a risk-off move?
Management argues it's genuine operational improvement. They're getting stronger results with fewer capital inputs. It confirms that the efficiency gains they've been chasing are compounding.
Which lets them defend returns even if prices stay volatile.
That's the idea.
And those reliable cash gains are obviously being returned to shareholders.
Precisely. The cash flow profile is entirely defensive right now. They returned $6 billion to shareholders in Q3.
$6 billion. How did that break down?
It was $3.4 billion in dividends and $2.6 billion in buybacks.
And critically,
the entire amount was more than covered by their $7 billion in adjusted free cash flow. They're spending what they earn.
and they're holding the line on spending too.
Right. They reiterated full-year organic capex guidance at $17 to $17.5 billion. So capital discipline is holding firm, even with integration costs. We'll get more on the long-term path at their Investor Day on November 12th.
Okay, let's turn to the international playbook. Let's start with Kazakhstan. TCO is still a powerhouse, right?
TCO continues to perform reliably. It's driving high equity affiliate dividends, including a $1 billion loan repayment this quarter. That just shores up the balance sheet even more.
But there's a planned turnaround coming.
Yes, investors should note that. Output will temporarily dip in Q4 because of a planned pit stop for maintenance. Totally normal for a facility of that scale.
And what's the latest on the tricky political negotiations over the TCO concession extension?
The CEO confirmed he met with the president of Kazakhstan. The conversations are productive, but
it's complicated.
It's a complex, sovereign-level negotiation. The process is underway, but they stressed it's just the beginning. It's going to take time.
So don't expect a quick resolution.
Definitely not.
Okay, elsewhere. Guyana obviously has huge momentum now.
Absolutely. The Hess integration brought first oil at Yellowtail and the final investment decision, the FID for Hammerhead.
These are major milestones.
They are. This secures a multi-year growth runway and shows the immediate strategic benefit of the acquisition.
We also heard them sound pretty encouraged by what's happening in Argentina's Vaca Muerta. Why the sudden optimism there?
Well, they expect modest growth, maybe 25,000 barrels a day in 2025. The optimism is really about the macro picture.
The new administration's policies.
Yeah, the stabilization efforts, the reduction of capital controls. Before, it was hard to get profits out of the country, which made Vaca Muerta less competitive for capital.
Even with world-class rock.
Exactly. Now they're making the Vaca Muerta, which has a similar scale to the DJ Basin, more competitive for future investment.
Speaking of future capital, that brings us to what I think was the most significant strategic pivot on the call.
Exploration.
For years, Chevron was so constrained in this area.
This point is critical. For years, they basically funneled all the capital into unconventionals like the Permian. Now the CEO says they're pivoting to a more balanced approach.
Which means?
It means they're ramping up exploration in high-impact frontier areas. They've added new country entries across the South Atlantic margin. We're talking Suriname, Brazil, Namibia, Nigeria, Angola.
That is a huge commitment. It requires a different kind of expertise.
It does, and they even brought in outside talent. Management confirmed they just hired the former head of exploration from Total to drive this new focus.
So they're serious about it. What about Namibia? I know there was a well result that wasn't great.
They addressed it directly. One well didn't yield commercial results, but they said based on seismic data, they're still optimistic. They're going to continue with a broader drilling portfolio there.
Okay, let's quickly touch on refining since it provided such a cushion this quarter. How does management view the tightness in the California market long term?
They see it as a policy-driven tightness. All the shutdowns and conversions to biofeedstocks have really constricted the market there.
So the state is just structurally short on supply.
And increasingly reliant on marine imports.
What does that mean for Chevron?
It means policy has effectively created a market with very high barriers to entry. For Chevron, with its huge refining and marketing presence there, it's like a durable, high-margin toll road on gasoline for the foreseeable future.
So with those high downstream returns, are they tempted to shift their portfolio mix?
No, not at all. Management reiterated their long-term target, about 85% upstream, 15% downstream.
Why not lean into the hot hand?
They view upstream returns as more durable over the cycle because they're, in their words, more self-correcting. They do favor targeted growth in petrochemicals, though, like those two huge joint ventures with Qatar Energy.
Fantastic breakdown. All right, now we get to the segment where we distill all this into a hypothetical, maybe outrageous but plausible trade idea.
And remember, this is purely an exercise in connecting the dots.
This is not financial advice.
Not at all. But if I were pitching this to a portfolio committee today, my thesis would center on two things the market is underestimating.
Go on.
First, the compounding effect of that accelerated Hess synergy realization. And second, that durable structural dislocation in the California refining market. It provides a really predictable high-margin cash flow floor.
Okay, so lay out the trade for us. How do you hedge the risk?
All right. You initiate a long CVX equity position. Simple. It's based on that defensive cash flow, the record volumes, the shareholder returns. But to neutralize the commodity price risk, since oil is near $61 and that's weighing on upstream profits, you hedge by simultaneously shorting a broad oil sector ETF, something like XLE.
So it becomes a relative value play.
Exactly. You're focused purely on Chevron's operational excellence and their integration premium over the rest of the sector.
That's the core trade. Now, what's the wild card? The optionality bet that gives you some real leverage.
The wild card is an aggressive, out-of-the-money call option on natural gas.
Interesting. Why not gas?
You're betting on the success of their international gas projects, Leviathan LNG, TCO optimization, all that long-term offtake to exceed what the market expects over the next 18 months or so.
So you're buying optionality on the combined portfolio's gas assets.
Right. And that call option is the cheapest way to capture that leverage if prices spike for whatever reason.
You call this the classic scale and scourge thesis. For the listener, break that down.
Scale is the new massive asset base, and the record production, the cash flow engine from Hess and the Permian. Scourge is the ability to use that size and efficiency to push out higher cost competitors.
That's right.
Or, like we see in California, to exploit policy dislocations that create advantages nobody else can touch.
That is a powerful combination. Okay, to quickly recap this deep dive. Chevron delivered record volume and a huge cash beat.
The Hess integration is not just successful, it's accelerated.
We're seeing major capital discipline in the Permian and a very surprising strategic pivot back toward high-impact frontier exploration.
Which leads me to my final provocative thought for you to chew on.
Let's hear it.
Given this renewed focus on frontier exploration, which is a higher risk, higher reward game, and with the big investor day coming up, what is the market currently missing about the resilience of this company's capital structure?
How can they absorb a massive acquisition and expand their growth horizon at the same time without stretching themselves thin?
Exactly, that's the question.
A fascinating question on capital and risk. We encourage you to keep exploring the material. Thank you for joining us for this deep dive.
We'll catch you next time.